Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at TOST Incorporated, ticker TOST. This, if you're not aware, is a restaurant order and payment management system. When my employer was looking for a new system to move on to, this was one of the options that we looked into, and I've gone to quite a few restaurants where I've seen it in use. So I wanted to take a look at the financials, see what we were looking at here, and if it was a stock worth owning, because I do know that it's relatively new. There's a lot of money in that space because you get a monthly subscription that you charge to all of the different locations that use your software. So what I'm looking at here is a fair value around $24. Personally, yeah, I think it's worth somewhere in the mid-20s. Discounted cash flows really low. Because their cash flows aren't the best. That's not the end of the world, though. This is, as I said, a newer company. They're definitely in the growth stage, definitely a growth stock. So we're not going to give up on them for that. But they are currently trading at a very elevated valuation of nearly $43. They have been as low as $21 in the past 52 weeks. So there was a point within the last year that they were worth their fair value, and that would have been a great time to get in because it's more than doubled since then. But we'll run through some analyst expectations, some fundamentals, and see what kind of valuation it's trading at and when it's worth getting into. So earnings yield looks really low, 0.56. Well, we'd be expecting a 2.14 based on the general market. I know this is more of a growth stock, more of a newer stock. Their PE is definitely going to be different from what we see for most of the market, but what we are seeing out of them is a 0.92 for this year and a 1.2 according to analysts for next. Nearly half of what we would generally be getting for what we pay for in the market, around a 20 PE. This one trades close to a 40 PE. Cash flows we already touched on. Their average is very low. It has gotten significantly better. That is something that I would like to see them continue to grow. They don't pay a dividend. ROE is really low, 1.23, and debt to equity isn't bad. So their balance sheet's in a decent position. They're just not getting very good returns. ROI, negative 19%, so they're getting very bad return on their investments, and return on their assets, 0.8. So not getting a very good return there either, and that's probably just due to the financials. I mean, the revenues look just fine. COGS seem to be growing in a linear fashion along with them, but then we come down to the net profit and EBIT, and that's where you're seeing things. They just crossed the threshold in 2024 to have actual positive earnings of $62 million and their net profit of $19 million. Amortization and depreciation are still a big factor, the separation between these two numbers. Gross margin looks okay, 24%, up from the 20 that we typically see out of them. Net just hit positives. So this is usually the point that I like to look at a company. When they just crossed over, they're now actually starting to make a profit. Because on average, it was negative 11% historically. PE, like I said, is a little high, but they're growing their earnings at a 30.5% just about percent rate, which gives them a price to earnings growth of 1.53. Still a little high. We like to see that 1 or lower, but that's just all based off the valuation. So if this thing sees a decent pullback, it get down to a price more warranted for the earnings that they have. Now we get down to our future projections for the company, and things are pretty easy here. I mean, CAGR over the last 3 years, 42.5% for revenue. 22 the last 2 years. Analysts are projecting 21.5, and then about 21. So 21 definitely seems like a fair number. Share count, we see that they have been issuing shares, 4%, 3%. I mean, I'd like to see them come in even lower. 3 is the starting point there, but let's see how much 0.5% affects things. You see down here, 16.55 is what we would be expecting in growth with this thesis. So I'm going to make this 2.5 because, of course, a lower issuance of shares is better for the shareholders, and that's a 0.5% boost to the shareholders right there. I mean, if they could just not issue shares, all of a sudden it's 19.5. And if they start buying back shares, of course, things are going to get better and better. And that's the ideal scenario. But we'll go with 2.5 for the thesis here. Cash flows, we see they're not in a very good shape when we go and look at them. They had 2 really bad years. 2023 was good. 2024 was great. I mean, if this is the new linear trend, then things are looking a whole lot better. So 1% is probably not too fair. That does bring them to a 2.5% yield. For them to hold their current yield of 6.2%, we'd be looking at something, well, in line with the revenues. That'd be 6.2. I wouldn't necessarily expect that. I'd like more than that, honestly. But let's give a little leeway. Let's just put that at 15%, which would bring them to about 5% cash flow yield, which is a reasonable cash flow yield for a lot of companies, somewhere between 5 and 10. Assets, consistently 11 to 11.5. Liabilities, 10.2, 9.2. I mean, I'd love to see it 8.2. So maybe 9's a bit more fair here. They do have more than they had previously. Dividend non-existent. Margins, I mean, they could probably grow this faster. 10% annualized growth in their margins would bring them to 0.62% net margin in the next 5 years. So start with a really small base. It essentially doubles their current margins. We'd like to really see that get somewhere between 5 and 10%. So this is a really low estimate, honestly. You know, if we really wanted to go low, then we keep the share count at the high point, cash flows, maybe just 10 there, about half their revenues. So this would be more of a bearish scenario, personally. Definitely a company who is investing and growing, and we're looking at super solid returns. Somewhere between 2 and 3x what you would expect from the S&P. And then if we get a more bullish case, this is where we say share count, okay, they bring this down to somewhere between 2, 2.5. Let's do 2 for a more bullish case. Cash flows, not only these now outpace revenues. In fact, I'd like to see them get closer to a 10% cash flow yield in the next 5 years. Something closer to 33% gets them there. Assets are flat, liabilities pretty flat, and then margins something even bigger than a 10%. Let's at least get over 1% in the next 5 years, which I don't think is too much to ask for. And so that'd be 21%, which means a bullish case would be almost 46% returns annually. Well, 46% annual growth in the fair value, which, I mean, buying at today's price would not be insane at that point. This is definitely one where you have a lot of leeway with the numbers. And then when we come to see how things are trending, we see earnings have gone positive in 2024 and are expected to continue going forward on a nice linear path. I mean, a bit of a dip back in 2023, but otherwise, growth here looks really good. The fair value is following a similar track. The balance sheet looks very flat, but the assets are outpacing the liabilities and growth, so that should continue to go up. And the cash flows here, I mean, they had those 2 bad years. Hopefully they can get on track. And if the revenues and the earnings are growing, all things else the same, these cash flows should as well. Especially if they're improving their margins, this should grow even faster. And then we have the actual share price, which was very high back in 2021, came down, was floating around $20 through 2022, 2023, started taking off in 2024. And now, I mean, like I said, people who thought this was a nice growth stock, you now have actual earnings out of it and really good growth rates. So I definitely see the value here. It's one of the better growth stocks, I believe, for my portfolio, but I would like a bit of a lower price on it. Like I said, mid 20s ideally. I mean, if you could have gotten in back at the 52-week low, you'd be looking really good, like significantly outperforming the market. Getting in at the fair value, of course, it's right around the same range. Getting in at the high, not too much higher than currently, but this thing is really trading at values somewhere 3 to 4 years out. I mean, if it continues at this growth rate, it's going to outperform the market in the long run for sure. But can it continue that for more than 5 years? I don't know. So this really looks like the ideal scenario for looking at for a growth stock. Aside from these returns are awful. It is overvalued. Cash flows need improvement, but we're seeing the improvement that we need, according to analysts. So I wouldn't go all in on it, but I would definitely dedicate a portion of my growth stock allocation of my portfolio into something like this. So I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks you should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.